Intrinsic value is one of the most important concepts in value investing. It is what value investing greats use to make their buying and selling decisions, and it is what all good value investors should be using. In this video, we're going to be going over what intrinsic value is and how to calculate it. We'll be doing this with a basic example, and in the future, we'll do this with actual companies. To start things off, we're going to pull straight from the Dhandho Investor by Monish Pabrai. In the Dhandho Investor, Monish goes over how every business has an intrinsic value. It is determined by the same simple formula. John Burr Williams was the first to define intrinsic value in his book, The Theory of Investment Value, published in 1938. Monish goes on to say, per Williams, the intrinsic value of any business is determined by the cash inflows and outflows discounted at an appropriate interest rate that can be expected to occur during the remaining life of the business.
Here's a little bit of a simpler version of that. The intrinsic value of a business is the value of its future cash flows discounted back to present using an appropriate interest rate. Let's break this down further. On a very simple level, businesses produce cash by solving problems for profit. They provide a product or service for others and get paid for it. Free cash is money that is left over after all obligatory expenses have been paid, both internal and external. This includes things like salaries, leases, payments on debt. Now, as investors and business buyers, we are looking to buy a business that will produce cash for us, the owners. By analyzing the free cash flows of a business out into the future, we are able to know how much cash is available to the owners after all obligatory expenses have been paid. Again, this is the amount of cash the business is creating for its owners. To determine how much this cash is worth to its owners, we must apply an interest rate to discount these cash flows from the future to the present. This is also known as a discount rate. In other words, we must apply an interest rate to future cash flows to determine how much it's worth to us today. Discount rates account for the time value of money. The time value of money is the concept that an amount of money is worth more now than the same amount at a future date due to its earning potential. This is because money today can be used, invested, and grown, and therefore has greater benefit to us today as opposed to that same amount, say, 10 years in the future. Consider this. If I were to offer you the option of $10,000 today or $10,000 10 years from now, which would you pick and why? Pretty easy question to answer, right? Now consider whether you would rather receive $10,000 today or $15,000 5 years from now. Now the question gets a little harder to answer, and that is where our friend, the discount rate, comes in hand. So for this example, we are going to evaluate the intrinsic value of cash printing enterprises, CPE. We're going to be going over the future cash flows of this business. We will start off with our assumption that the current free cash flows, as in last year's cash flows, were $1,000. Next, we need to apply an expected growth rate to help us find what our future free cash flows will be in years 1 through 10. And our discount rate is the return we are looking to make. We will start with 15% expected growth rate for the next 10 years. And then for our discount rate, let's go with 10%, as this is the percentage that Monish Pabrai uses in his book. So here are our values. We end up with the 15% growth rate for every year. Here's 1 through 10, and then we sell on year 10 for 10 times year 10 free cash flows. So with this table, we can see our free cash flow in year 1 is 15% more than 1,000, so 1,150. And then with our discount rate of 10%, this is telling us 1,150 1 year from today is worth 145 to us right now. Similar things for all these other years where it grows at 15% every year, and then we sell the business at 10 times free cash flow for year 10. And then we've got our 10% discount rate applied to every individual free cash flow. Now, a couple things to note. Obviously, higher expected growth rate will increase our free cash flow over each consecutive year. Also, the discount rate, the higher return we're looking for, the lower price we need to buy the business for. So we can see with the 10% discount rate, we end up with our intrinsic value, which is the summation of all present values of future cash flows. And we're just looking at a 10-year period. And we end up at $28,471. Now what this means is if we were to buy cash printing enterprises, we would need to pay $28,471 to get a 10% return throughout the life of this investment. This would be our intrinsic value of all these future cash flows discounted back at a 10% discount rate. Now, something to note about discount rates is the higher return we're looking to make, the lower price we need to buy. And if a business is offered at a certain price and the intrinsic value is significantly below that, that means if you were to buy it at the current price, you will not achieve your desired return. So look at this. Say we're wanting to get a 15% return. Update our discount rate. That means we need to buy this business for $20,000, whereas previously, with the 10% discount rate, you could buy for $28,000 to get a 10% return. A couple other examples. If we want a 5%, you can buy it for $42,000. If we wanted to get a 25% return, we would need to buy for less than $11,000. So pretty significant swings in each direction, depending on our discount rate. Now, a couple things to note on intrinsic value. As value investors, we are not willing to pay the full intrinsic value. This acts as a baseline to inform us. However, we are willing to pay less as this value and the future cash flows are not guaranteed. Therefore, we apply a margin of safety. Now, this is generally anywhere between a 20% and a 50% haircut of our intrinsic value, and that is the amount that we are willing to pay. The cheaper we can buy it, the higher our return. Being able to calculate the intrinsic value of an investment is an extremely vital skill. You can invest and value stocks on the stock market, you can value private deals, and basically any financial asset that spits off cash flow over some period of time. Anyway, if you guys want to check out Dhandho Investor, I'll have a link down in the description below. So hopefully this made sense, and hopefully you got value. If you did, make sure to hit like and subscribe if you want to hear more about investing, and see you in the next one.